in real options and financial risk, which means he knows a little bit about sort of the Greek numbers, the Greek letters and squiggles and things like that. But what he's going to talk with us about today is really a data-intensive exercise, I think, looking at what we can understand from the data that's available about performance of superannuation funds. Zili, I'll aim for 20 minutes.
Okay.
I'll put, if you go to 25, I'm just going to yank you off the stage.
Okay, that's fine.
And then we have Martin, I think, is going to make some comments. So we'll aim for maximum 25 for each of the sessions, maximum 25 minutes for the speaker, 10 minutes for the discussion, which then leaves another 10 minutes for general questions and discussion. Zili, over to you.
Okay, thanks. Thank you very much for the invitation to be here. So basically, I'll give you a presentation about some preliminary work we have done with the ATO data. And I think in the abstract somewhere, somebody wrote for us, there was a talk about the DHS and DSS data. That certainly is the objective of the project we're doing now. So it's still, maybe next 6 months later, we'll get that data. But at this stage, we only got the ATO data. I just want to make it clear. So.
Sorry.
Okay, yeah. So within the ATO data, what we have done is basically the data quality, I have to say, is not as desirable as what we have wanted. The reason for that is ATO has an issue about confidentiality disclosure. So that's why they try to hide obviously IDs of the taxpayers. And depending on how much information we ask from them, and they might have to, for example, if you have to ask a withdrawal amount for self-managed fund or APRA fund, then we can't get the salary level. So we have to input the salary level. Anyway, so the presentation here, we won't be talking about salary because it was not in there. So we could have used 9% as a factor to figure out what kind of salary level they have, not just the implication. Anyway, so that's give you the idea of the restrictions we have in terms of getting the ATO data, get the results, making it sensible. There's still a lot to be done. For example, we have, I know in today's talk, Noah is going to talk about the gender gap. So actually, just that's why I was likely a little bit, not because of that, but also because of traffic jam, was that we can actually see the number of male against female, the number of percentage of getting APRA amount. APRA funded superannuation, APRA regulated superannuation, or self-managed one. You can see clearly, obviously, male has a much high proportion compared with female. Of course, the number one, that's why I was late, is we're trying to get, okay, what's the median balance account for male and female. Unfortunately, we don't have it yet, and next time we'll show you. Yeah. Doesn't show?
No.
I can give you mine.
Have you got yours? Sorry, Zili.
Yeah, it's fine.
It's not linking. I don't know where it is. It was linked before. Thanks. It was working before.
That's all right. So that's one thing we could have shown. Actually, that's a new one I'll show you. And that was the age gap. Sorry, the age gap and gender gap results. Okay, so that's the ATO data. And what the plan or the way we work is we have the ATO data give us the raw data as, for example, the withdrawal rate. Yeah, good, thanks.
Right.
That's okay. No problem. Yeah. So that okay. So we have the data to get estimate, for example, how each year people withdraw their superannuation, either self-managed fund or APRA-regulated one. And so that's the information we need to factor in, to put as input into a forecasting model, so we can forecast as a typical 65-year-old how long their fund is going to last in terms of giving the data from ATO. And of course, lastly, what we can do is from the forecasting how many years the super fund can last you, when we can go to the next step, which is how do you build a dynamic portfolio so to extend the years, or reduce the ruin years, or extend how long the capital can last you. So that's what we call the dynamic decision analytics. That's like a portfolio management tool. And lastly, one thing I want to touch very quickly about is that we've also been looking at new products. For example, variable annuity. I think the variable annuity has got a very bad name because the annuity name. And I think some suppliers will change their name from variable annuity to capital protected investment. I think actually it's a very good product. But anyway, that's not what I'm here for. Okay. As you can see, I'll give you a list of the rough statistics about the data, how much data we got, and what's percentage. For example, the important one, 27% is self-managed fund only. People only have self-managed fund. 39% are APRA regulated one, and of the rest, 34% are people who have both, and self-managed one and APRA regulated one. And another thing is important is here the rounding off error, $1,000 for people under 250,000, and above that becomes $10,000 as a rounding off. And of course, you can see why. Why can't just give you the dollar? The issue is about confidentiality issue, and that's why they have that. And anything above 5 million, we actually just get 5 million, so we don't know who's got 6 million or 7 million. And of course, here you would, so you would have the basic percentage according to age, and for self-managed fund, and also for APRA regulated one. Just give you an idea of the distribution of age groups within the data. Okay. So that's actually a very good picture. And because yesterday, day before yesterday, we had a talk, and somebody was arguing that the data is not representative, it can't be trusted, or whatever. Actually, we just got back and try and check out, are we doing the wrong thing or not? So here, if you look at the median using non-zero, so basically you can do, when you have accounts, you can have zero value, and you can exclude them, or you cannot exclude. Obviously, it makes a huge difference to the median value you're getting. And if you're including zeros, in my view, that's a better representative of what's going on in the market. And the self-managed fund, the median is 330, and APRA is 29,000. That's very low. But if you go back to the one with non-zero value, excluding zero, the median value for self-managed fund 440, and that's correct, 440. Sorry, this is for the 10-year period from 2004 all the way to now. The verification I was trying to say is that if you look at, I'm not going to show it here, is that if you look at for age 65 at this year of 2013, 2014, 65 was the median asset value of the self-managed fund. That's what we got is 480,000. Whereas we have information, I think published by Challenger, their estimate was 470,000. So that's pretty close. And they published in 2013, whereas obviously we just got data now. So that means, well, at least I'm trying to draw some kind of verification from other sources to see are we getting the right data or not, and are we doing the right thing by, can we do the averaging correctly or not? So that's basically give you an idea. Yes?
Is the SMSF average per SMSF or per member per SMSF?
It's for all the data points.
Okay.
Zero. So basically, if you have somebody, it's all averaging.
Yep.
So if you look at somebody who is obviously 58, for example, 10 years ago, now becomes 68. So their account will be counted 10 times.
So if there's 300,000 self-managed super funds and there are 2 members per fund, is it total assets divided by 300,000 or divided by 600,000?
I think this will be individual because it's ATO data, and all ATO data is about individual tax returns. Would that be right?
That's correct, yeah.
Okay.
So it's their share of the SMSF would be in the return.
What do you mean share?
So let's say you've got 2 members, and the average is 440.
Yeah.
So is it 220 each?
Oh, no. So that will be somebody like a 550, another person might be 350.
Right.
So the median might become 440.
Okay. I think there was the answer to your question.
Yeah. So instead of the mean value, the mean value here 712,000. That's taking an average.
Yeah.
So everybody average, which obviously is not good because somebody might have 10 million. That'll make it go very high. So this is like a kind of median person, if you think of it. It's like above it 50 people, below it 49%. It doesn't mean there. It works actually. Okay, so that's what we're trying to get out before I came here, is looking at the age gender gap. So you can see so the thin line is the male, and the thick line is female in terms of proportion of the funds collected for self-managed fund and also for APRA, and across the age group. So you can see, obviously, for self-managed one, this roughly 61, 62, the peak, whereas here is, I think it's lower, 67, 68. Anyway, we're trying to get, according to bank balance out there. Anyway, we didn't get a chance to get it out. Okay, I'll go through this very quickly. I think it's, at least I can't see a lot of information from here. This gives you a rough idea of, for each year. This is averaging 10 years according to age group. So for example, here 65, looking at the median values here, and 25 quantile up and 25 going down. And so that gives you an idea of the distribution according to age and also for APRA account. So that's average. If you look at this next one, that's more illustrative in my view. This is looking from 2005 all the way to 2014, looking at each year how the self-managed fund, the median value, return on self-managed fund compared with APRA. So APRA is doing a lot better, well, I wouldn't say a lot better, doing better than the self-managed fund in terms of median value, return. And later on I'll show you something else, and that might upset some people here. Anyway, so that's give you an idea. Obviously the financial crisis kick in, and you can see the self-managed fund median value goes negative, and where APRA one is not. One thing is very important here is here the contribution is actually included. So this is return including the contribution. Later on I'll show you the numbers without contribution. And this is from year, each year you get a median value. And of course this is a distribution across age group. For the performances, this is basically average, right? So that's not from 55 all the way to, I think it's 85. Once you get about 80, the number of data points become much fewer. So that's why the data is jumping a lot. But this is actually not because of that. This is because the rounding off error of 10,000 or 1,000 is causing problems. I wouldn't go into details on that. Just give you an idea. So that's all including, that's the median value. So this is median value of self-managed fund compared with APRA. So this is across different age for year 2006. Of course, if you use that against 2013, you can see the distribution of from 58 or 57 all the way here, and how it's quite flat. This is the same year, 2006, for APRA against 2013. So obviously, this gives you a rough idea. You have to look at the detailed numbers to see what's difference, what's change. Okay, so that's a more kind of going through the time slides. 2007, 2009, how it changes. I realize I have 20 minutes, so I better go faster here. And this is a self-managed fund. You can see that 59, the year 2007, is actually, if you look at the balance, around 69, 70, it's going well. Okay. So if you look at the APRA regulated funds, the 2007, obviously the median value goes down. And also another one is here, the width of the band indicates how much data we have. So if you get to 675, 77, you can see the data becomes much less, so less reliable. Or maybe actually it's not less reliable, just indicating less people having bank accounts there. Of course, this is APRA regulated one from 2011 to 2013. You can see I suppose the market is going back up. You can clearly see the performance increase there. Okay, whereas the self-managed fund is not changing that much. Okay, so this is an interesting picture. This is exactly what we had before for per year 2006 to 2014, excluding member contribution. And you can see the upper one is almost tracking the self-managed fund. And if you look at if you average the median value, that the return across age group, average over age group from 55 all the way to 80. And so when you're younger, you get a lot better return. Afterwards, it goes downwards. Why? I don't know.
Is that including drawdowns if you've included contributions?
No drawdowns.
No drawdowns?
Yeah, so this is the problem here. One thing is that the APRA funds, we don't have drawdowns. They don't have the number. Whereas for self-managed fund, we do. So later I'll show you so this is basically the same picture going through each year to see against age group. All right, so if you look at 2006, 55 to 85, how the performance changes according to age. And you can clearly see when 2006, 7 is doing very well, and especially people who are older, having APRA funds. They're having a great time there. And until 2008, and then you can see it start to be negative. This is across age. This is 0 performance return. This is all negative. 2009, 10, flat, 11 flat again, 12 start to go back. Okay, this is the withdrawal rate for self-managed fund. And so for different age group, if you look at the 60 to 64 age group, the proportion of people join at under 2% is the highest. Whereas as you age, the proportion of people join higher and higher. So once it's 65 to 69, it draws more. Of course, once you get 70, so the center of gravity, if you think of it, moving toward the right, old age group. That's pretty much what we look at the different age group. This is the average draw rate, and this is the number we use to try and forecast how much funds is going to be run out, how long it's going to take to run out, because for each age group, at what balance you get, for example, at a $200,000 balance plus your self-managed fund, this is the drawing rate, depending on the age. So from that, you can work out each group, so each age group, what stage of their life, and what account balance, and the rate of withdrawal. Okay, so this is actually a very interesting one. This tells you how people close their accounts. And so the self-managed funds, people only have self-managed funds, then at age, different age, 55 to 85, the rate of closure. And this is the one I think everybody's been looking at, is that at 65, suddenly there's a huge jump in the rate of closure. So you can imagine that when they retire at 65, they basically close their APRA account, moved all the money somewhere else. Where, we don't know. And so this is the second one is when people have both accounts, self-managed fund and APRA one, and that's pretty flat when they close the self-managed fund. Whereas they have both APRA and the self-managed one, how they close their APRA only. Of course, you have to do another analysis to see when they close APRA account, how have they shifted over into self-managed one, or vice versa. And that we can do that easily.
Let's leave questions at the end, because otherwise We're going to time. Okay.
Okay, so that's the data analysis, is all done. And this I'll just go very quickly. I think people are not very interested in that. So we also build a model, which is kind of a macroeconomic model called wiki model. So you can use inflation to drive how the share market moves for the next 10, 20, 30 years. CPI, everything goes in. And then you can forecast the wage index, how it increase. And from that, you can use that to work out if you start from age of 25, a normal salary, how much you're going to get roughly in terms of how, when you get to 65. And we obviously, when we do models, we always rely on Excel and put the DL attached to Excel. So if people are interested in using it, we're happy to provide it. You can take it home and play with it. And the value we get from that, we'll get feedback from you. And so that's one example of in September when we have the government changing the decision to change the rate of contribution and how we use the same model to forecast how it's going to impact on how long it's going to work and how much money you're going to expect to get. I don't think I want to go through too much detail here. This is one case where we use the model to forecast somebody starting from 25, accumulate all the way to 65, using the macroeconomic model, wiki model, and then from there go onwards, using the rate of withdrawal for self-managed fund from ATO to forecast how long the fund is going to last. So here we have a 10% rule, and expected year is actually 33 years. So it's actually not bad. So it's rule year is only 0.64. And of course, we use what I calculated at age 65 this year. The median value for self-managed fund is 480. So we use that as a starting point and trying to forecast with the same drawing rate to predict how long the fund is going to run out of money. So the probability of ruin before death is 6.9, and expected year length is 33 years. Yep. And lastly, just give you some idea of what we're doing here is we use this what's called multi-period optimization system. If you use that kind of portfolio management against the CAPM, which I think everybody knows here, how much benefit you can get from the red line against the blue one. So it's all dynamic in terms of you know exactly what you're going to do today, but you need to make a different decision depending on what happens next year with the share market and also how much your funds is performing. And so this is a typical case of if somebody has at the age of 65 and $1 million, how much money you should put in the share market, overseas, domestic, and how you're going to move slowly from share investment onto annuity. When I say annuity, it's not annuity, it's really a liability. So the aim is that at the end of the year, end of 30 years, you want to cover all your liability, which is expenditure, which is $42,000 today, multiplied by CPI for the next 30 years. And lastly, we have, I think I won't say too much, is variable annuity products we can price using the mathematical models we developed here in CSRO. That's it. Thank you very much.
Thank you, Zili. There's a huge amount of information in there.
Yeah.
Probably too much for people to draw it all in. But I mean, you've covered some of the data, what's actually happening there. You've looked at things like what's going to happen in terms of how long their assets will last compared to their age. You've looked at how you might design retirement products and how you might price them and what strategies might be used. I mean, that's a lot of stuff.
Well, it's not obviously.
So Martin's now going to tell you all about his reaction to it.
Yeah, so look, I think three questions that are in the market that perhaps you'd like to reflect on in terms of data is the age-old question of how much is enough? Because that's in the market. Like, how much do you need in your combined self-managed super fund and your APRA fund to make sure you've got enough to live till you pass away? That's obviously a question. Two, do you think, based on what you've seen in the data, that asset allocation has a big effect or not so much? And thirdly, what's the data you wish you had that you don't have right now? So they're the three questions. So first of all, do you think this informs the debate about how much you need?
Well, to be honest, I don't know the precise answer, obviously. So from what we get, like say for self-managed fund, 480 as 65 so far, median value, it gives around under 10% probability of running out of money before death. So that's actually a low probability in my view.
Yeah.
And obviously it depends on, it's all factored in all the macroeconomic model. So that's the number. If you say, should it go higher or lower, I have no clue. But my view is that if you ask people, say, look, you got 480,000 and give up on upside trying to be safe, I think actually it's the wrong strategy. It should be, people say, oh, when I get to 65, then I should really be conservative. I think it should be slowly moving from obviously share market into conservative in terms of covering your liability.
Yeah.
So that's the objective rather than being conservative. And to cover your liability, the best chance is actually getting upside rather than limiting your upside.
Great. And the last question was, in terms of all the data you've seen, which is the bit or the additional data you would like to have for the next step of your analysis?
So for us, the next step is trying to get data from DHS. So we are in the process of negotiating with them. And the important one there is assets. So in the DHS, they have data on, for example, if you're a pensioner or part pensioner, you would have the bank account details all there in their database. And also the family home asset value is there too. So what we want to get, obviously, the asset value, how people, like say, if you're on full pension, what's their, they might have $10 million house.
Yeah.
At the same time, if you have inheritance, where the money going? Did it go to a cash account? And the second phase is, from that onwards, is when they move into, for example, retirement village, how they dispose their assets.
Right.
And so that's the last one. There's another one on medical expenses. That's also we want to know.
Yeah.
That's obviously very important in terms of, do you have, for example, delayed annuity products where you can cater for health cost expenses. So that's all part of the whole picture.
Great. Look, I think we'll throw it open to questions now, because I
That's
know
my job.
everyone's keen to do that, so Kevin's just reminded me, don't jump the gun, mum.
So let's run over to questions. Who's, or comments? Bernard.
I wanted to raise the question about performance. What one's actually showing here is changes in account balance, which are a function of a variety of things, including what you've put into the account, and under some circumstances, but it was rather unclear, what you might have taken out of the account, and over and above that, there is the yield which has been earned on the principal that is in the account. Now, performance, as I would understand it, is about the yield on the sum which is on the principal there. That's what I call performance. The rest of it is all about deltas, changes in account balances, and I was rather unclear as to actually what was going on there, especially since it seemed to be unclear as to whether we actually knew about withdrawals, whether we actually had data on withdrawals at all. You seem to have data on withdrawals from self-managed funds, and you refer to that, but I'm not sure that I understood that we actually knew about withdrawals out of the APRA type funds. And then you did raise the interesting question as well, that some of those withdrawals, if we do know about them, might not be, and this comes under the question of closure as well, is that these withdrawals might actually be simply money being moved from one kind of account to another.
Yeah, so for the APRA regulated one, we don't have the withdrawal data, and so what we have is contribution. So that's why I couldn't exclude contribution. Anyway, I'll answer your first question about returns. Obviously, I would imagine everybody knows what the returns. You invest $1, how much you get next year. So excluding withdrawal and contribution. So that's it. And of course, the second question you asked is, so what we do here is we can estimate, or kind of guesstimate, the performance of APRA funds, not as each individual, but just as an aggregate from the data. The reason for doing that, for example, we could use from 55 to 60, thinking that anybody who has APRA regulated funds can't withdraw. And from the contribution rate, we can deduct the performance. So that's how we can use that as performance indicator of how well it does. But anyway, so that's the answer to you. I think the important thing here is, obviously, we want to know what's the balance. Who cares about it is what's performance or whatever. It's more at the end of 65 age. What's your balance and how we're going to go about it.
Thank you.
Sure. So thank you. I can't wait to read this paper because there's quite a lot of information to digest. It seemed like there were a couple of themes. One theme was, what's the state of play with APRA funds and SMSF funds, and what's the lay of the land there? And then the other theme was, what type how can you get an optimal retirement product? How do you price it? Not unrelated, but two kind of different themes. On the first theme of SMSFs and APRA funds, the thing that struck me as you were going through the talk was there's quite a lot of heterogeneity in SMSFs, especially in terms of asset allocation. And in terms of APRA regulated funds, there's quite a lot of heterogeneity in terms of asset allocation and business models. If you're going to do the performance difference in comparisons, you might want to do some break-aparts to capture that heterogeneity. So that's the one thought on the first piece. And then the second piece in terms of pricing and preparing optimal retirement products. Curious whether you at some point might take into account, because it looked like those outcomes were, if an individual was trying to risk manage themselves, what asset allocations and when would they make those moves and how much would it cost? You might want to think about, well, how could you do it as a pool? And how might that change? Those are the only things that struck me what was very interesting stuff.
Yeah, thanks.
Okay. Other comments, questions?
I think the answer might be no, but will you or can you get access to the level of MIC option switching for the APRA data, and then maybe something similar for SMSFs if they change their asset allocation over time? It's quite interesting to see what retirees do. As you said, they still need some growth assets to carry them through the 30 plus years, but to what degree do they do that?
You mean switching from one fund to another?
Yeah, so for APRA funds, there's a lot of member investment choice options. Some of them are premix, some of them are single sector. So
classic,
it's basically their asset allocation.
Yeah, we don't have that information because obviously the APRA regulated fund passes information to ATO. ATO put them aggregated together. So there's only one number for APRA fund. So we don't know which one they're going into. That's why we can't get the performances.
So, Zili, can I ask on your when you started, you said it was roughly a third of the people who had APRA fund only, roughly a third had
roughly,
SMF, and a third had both.
Correct.
Was that the way the data was constructed, or is that a random sample of people aged between 55 and 90?
No, it's 55 and 90. So that's the main one, and randomized. And at the same time, so when I say randomized, is that because obviously self-managed fund, they actually file their own tax returns. Okay. So what we want is randomized in the self-managed one, whatever they got. I think it's roughly, I don't know actually, 800,000.
I guess my question is, I was surprised if does that distribution of a third only being APRA, a third only being self-managed super funds, and a third having both, is that typical of the population of people in this age group, or is it?
I don't know the answer. So we said, okay, obviously our focus is on self-managed fund, but also the APRA data comes in automatically. Have they picked just 1/3 each? Actually, I can answer the question next time.
I'd be really surprised if that's sort of what the world looked like.
So the 1/3 was built into your sample size as opposed to being an outcome of what you found.
No, the one third is the data points we got.
Okay.
Yeah.
Yeah.
So that's good, very good point. So yeah, we got all chase that out.
Because the other sort of flow on from that is, you know, the theory that people are switching out of APRA return funds into SMSFs
Yeah.
at that retirement age. Is that theory holding up in terms of what you're seeing? In terms of, you know, the funds are all trying to develop retention strategies because of the fear people will shift into SMSFs over time. The question is, does your data support that proposition?
Okay, so I can't answer that question. That's what I said earlier. We should pursue that. I should be able to get it as to how accurate it is a different issue. So the point is that when the data comes in, you have a APRA only, self-managed fund only, plus both. Right. So obviously what we need to do is go find the both ones, or the one third both, and see when the APRA fund becomes zero, has that self-managed fund increased by the same amount.
Yeah.
So that's how we can do that analysis now.
You've got the data.
Yeah, we should be able to do that.
How much convenience yield is there in self-managed super funds? As in, you know, family members using assets of SMSFs for private purposes that are not priced at market prices?
Well, one thing, I do not have the data, and I don't know myself, but I'm guessing that, for example, the self-managed fund can have properties. Right? Obviously, there's an arm's length kind of transaction there. And how they value the property, obviously there's no market price for it. I have no clue. I would imagine they do a revaluation by the owner to provide that data to ATO. No, that information is not available.
Could I give you a little bit of insight into that as the auditor of the MLC self-managed super funds? I can tell you that it's supposed to be based on market data, which is an independent valuation. And the tax office is pretty dynamite if it's not. So even though there may be some things at the edges, as a general rule of thumb, it's accepted that you'll have a market valuation. So I think there might be a little bit in terms of the valuations of private companies or such, but generally there is a move to people doing things the right way in terms of those self-managed super funds for fear of having it being disallowed.
Thanks for that.
Yeah, I just wanted to say, Zili just presented this over the last couple of days, and it's really important to say that it's really preliminary work just yet, a first look at the data. So many questions haven't been examined yet, but it's an incredibly exciting project through the skills of big data analysis and CSIRO.
So one question I had, Zili, was you've got the withdrawal rates from the self-managed super funds in retirement. One of the, and I guess I couldn't see from the slides what those rates were, you know, what percentage are they drawing down, because my understanding is that for the APRA funds, the general situation is that members in retirement draw down at the minimum possible, generally draw down at the minimum possible rate as allowed under the legislation, reflecting the fear that they're not going to have enough money to last out superannuation. So what sort of, how do the self-managed super fund drawdown rates relate to the minimum?
Yeah, so actually, maybe from your angle you couldn't see it clearly. Actually, the self-managed drawn rate was I showed there.
Yeah.
So obviously, if you do an average, it's very broad, right?
Yeah.
It's like above around 4%. But if you look at that's why we broke down into different balance. So depending on how much you got, if you have 200,000, that's much higher. I think it's roughly average around 6%. That's in there. Yeah, so that one, that's average drawn according to age. And then if you look at a very low balance.
And what's on the vertical axis? What are the numbers?
That's the percentage.
Yeah.
So it's very, you can't see it clearly. Yeah, so like 65, obviously it's just started, and then it goes to, I can't even see myself, 4%.
Yeah.
And as you age, higher age, and then it becomes higher and higher. Of course,
that's not going to be much different to what the minimum requirements are. I mean, from 65 to 70, it's what, 4%, 5% or something? So So,
Yeah.
so I guess my question is there a differential experience or a differential behaviour of self-managed super funds in the drawdown compared to what we know about the APRA funds?
So the APRA fund, unfortunately, we don't have the majority. That's a problem. So that's the average one, like you said. That's roughly according to the law, right? Whereas, but if you break down into different balances, there's certainly a difference there. For example, the low balance, that's much higher than high balance, which is common sense, I would imagine.
But I guess I'm surprised there that if you take the very high balances,
Yeah,
then up to about age 80, the drawdown rate is 4%.
yeah, and then keeps
But they have to draw down more than that, don't they? Isn't that a requirement that your drawdown rate is linked? The minimum drawdown rate is linked to age, isn't it?
It's presuming that it's in an income stream, it might still be in the accumulation phase where there's no minimum drawdown requirement.
It'd be crazy to keep in very high balance. It'd be crazy to keep in accumulation mode and not get the tax benefits, wouldn't it?
But it could be a mix of members, or are these individual members? Because is there a younger generation in this one?
that's the individual member.
Individual members,
Yeah.
okay.
So it might be worth looking at that in a bit more detail as to how whether those things actually reflect. I mean, aren't they consistent with what the legislation says?
Yeah.
That's my.
These are averages?
Median.
Median, okay.
Yeah.
So, anyway, yeah. Got a couple of minutes left. Any other questions or comments?
I just want to say that if somebody will have some particular question want to ask, to say, oh, can you look at the data to see, can you find this or that? Just send me an email. If we can do, we will do it.
Sorry, yeah, good question.
Zili, have you approached any of the super funds or any of the funds to ask about their data, if you can capture and take their data to use for your research?
We have, certainly we approached APRA, and it's very hard to get any data out of them. I'm not trying to blame them, it's more kind of, I think, a different task. And the problem here is that obviously people change funds all the time within our, so it's very hard to track them. And so even if you go to, for example, a company X, Y, they have the performance very good, 25%, but somebody might be in there only 6 months. So I would say, if you really want to see what's going on in terms of people's, how much money they got for retirement, that's a better data than just looking at one company's performances.
Okay. Any other questions? I think, Zili, there's a lot of potential in here in terms of getting into the data, understanding the data, seeing, because we know that to design sensible retirement products, we need to know how people behave. This gives us some insights into how they're behaving, which I think is very helpful in the context of saying, how can we go about designing good retirement products that people will be attracted to and which will help them manage longevity risk and the other risks associated with the retirement phase. So I applaud you in terms of digging into this deep into this data. I mean, it's a tremendous effort to actually get on top of it, and I think we look forward to seeing a large number of papers coming out of this, identifying all of the various bits that you're working on. So could you join me in thanking Zili for